And when these forces are pushing against each other, right, they're going to cancel each other out to a great extent. But don't think this is stable. This is dynamically unstable. Imagine two tectonic plates pushing against each other. That's an unstable equilibrium. It's going to snap, but which way will it snap, deflation or inflation? One is that, look, if I said we're definitely going to have inflation, you wouldn't need me to tell you what to do. Everybody would know what to do. Get some gold, get some land, get some hard assets, hunker down, take a little leverage if you like, and then make a lot of money. If I said we were definitely going to have deflation, again, you would know exactly what to do. Get some bonds, get some cash. Value of cash goes up in deflation, et cetera. But what if I said we're on the knife edge of inflation or deflation? There are powerful deflationary forces which come from debt deleveraging, demographics, and technology. Debt deflation, demographics, and technology are powerful deflationary forces. On the inflationary side, we have central bank policy, basically money printing, QE, QE1, QE2, QE3, QQE from the Japanese, negative interest rates from our friends in Europe, now spreading to Japan, currency wars, forward guidance, I mean, the whole Operation Twist, the whole grab bag of central bank tricks designed to get inflation. Well, we haven't had extreme deflation, certainly some deflation in Japan and some hints of it in the U.S. We haven't had extreme inflation. We haven't had either one. But that's not surprising. When these forces are pushing against each other, right, they're going to cancel each other out to a great extent. But don't think this is stable. This is dynamically unstable. Imagine two tectonic plates pushing against each other. That's an unstable equilibrium. It's going to snap, but which way will it snap, deflation or inflation? It could go either way. In fact, actually what you want is a robust portfolio that's prepared for both. But that's the state of the world today. So that was the first point. That has not changed. And so it's confusing. Oh, I'm ready for deflation. Well, here comes a little inflation. You know, well, I'm ready for inflation. Well, manufacturing is declining. World trade is declining. You know, exports and imports are going down together, et cetera. So the way to understand it is two opposite forces in play at the same time. To quote F. Scott Fitzgerald, the sign of a first-rate intelligence is the ability to hold two opposed ideas in mind at the same time and still retain the ability to function. I put a lot of emphasis on that last clause. But you have to take two opposed ideas, inflation, deflation, hold them in mind at the same time and process that to really understand what's going on today. The second point I make is that the world is not always in a currency war, but when we are, they can last a very long time. What I describe as Currency War I lasted from 1921 to 1936. What I described as Currency War II lasted from 1967 to 1987 with the Louvre Accord following the Paris Accord. Currency War, so one was 15 years, one was 20 years. Currency War III began in 2010, and if you go out 15 years, we're looking at 2025 to 2030. The reason currency wars last so long, they have no logical conclusion. They have no logical conclusion. The only way a currency war ends is either the system collapses or you reform the system. You can reform the system as we did at Bretton Woods or as we did at the Smithsonian Agreement, the Plaza Accord, and the Louvre Accord in the 80s, or you can let the system collapse as happened in 1914, 1939. So those are your two choices, but they don't end on their own because they just keep going back and forth. Five currencies can't all devalue against each other at the same time. If somebody's devaluing, somebody else is going up. That's just mathematically an identity. It can't be any other way. And so this is like the craziest thing I've ever seen. But it's like, aha, you devalued the yuan and nobody noticed because the guys who got stronger were Europe and Japan, and the guy everyone's looking at devalues too, and so that cross rate's unchanged. So nice job. I find that effective in the short run. None of this will be effective in the long run, but I find it effective in the short run. I find it remarkable, and I find it impossible to believe that that was not coordinated. So my analogy here is that imagine five soldiers are fighting. Right? 5 soldiers are fighting. They're exhausted. It's a hot day. It's 30 degrees centigrade, 100 degrees Fahrenheit, and they've got one canteen. They're all thirsty, and they've got one canteen. What do? Well, everyone would like to drink the canteen, right? But you don't. You take a sip and you pass it to your buddy. He takes a sip, passes it on. Everybody takes a sip. Nobody gets everything they want, but everybody gets something. But you have to take turns, and that's the way it is in a currency war. So, sorry, Japan and Europe. They got their weak currencies in 2013, 2014, 2015. They got a little lift. Not as much as they wanted, but that's all they're getting. Now the canteen's being taken away. U.S. and China are going to take a sip, look for a stronger euro, a stronger yuan. Ben Bernanke actually came up with a name for this. We all know from the 1930s, we heard about the beggar thy neighbor devaluations. That's supposed to be a bad thing. But Bernanke said, well, the problem with beggar thy neighbor, the 1930s original currency war, he said the problem was it was uncoordinated. In other words, France devalued in 1925, and England devalued in 1931. The U.S. devalued in 1933. France and UK came back in 1936. That was a tripartite agreement. But none of it was coordinated. They just kept whacking each other until finally the system collapsed, and we ended up in World War II. But what Bernanke says, if we coordinate, if everybody eases at once, for example, we can get the benefit of easing without the volatility in the cross rates. So he said, this is not beggar thy neighbor, it's enrich thy neighbor. And that's a quote, by the way. That's not me putting words in his mouth. That's actually, Bernanke said that in Tokyo, October 2012. And I was shocked that a chairman of the Federal Reserve would talk about the dollar at all, because they're not supposed to. That's the Treasury's job. But for a chairman of the Federal Reserve to talk about the dollar in Japan, in a foreign country from the U.S. perspective, was shocking. So told me that Geithner had green-lighted it, that he had permission from the Treasury. But Bernanke laid this out. He said, well, what was sloppy about the 30s was not the devaluation, it was the lack of coordination. So that's the mental framework for the coordination we're talking about. We've just seen it in spades. In 5 business days, 3 central banks just devalued the Chinese yuan, and China didn't do anything. I'll offer a quote from a fictional character with a real-life author. The character is Auric Goldfinger. Once is happenstance, twice is coincidence, 3 times it's enemy action. I would apply that to what's happened with central banks recently as a way to understand where we are today. China needed to devalue, no doubt about it. China's economy is falling off a cliff. They've got limited policy tools. They can't, they've got a massive run on capital. Capital's leaving the country. How do you defend yourself when capital's leaving the country? There are only 3 ways. This is the impossible trinity. You can close the capital account. Well, they're not going to do that because they need to stay friends with the IMF. You can raise interest rates to keep the money at home. They're not going to do that because they'll sink their economy. Their economy is already going down. The third leg of the so-called impossible trinity, or the trilemma, is to devalue the currency. So then there are only 3 choices. This is Mundell Fleming, 1960, a seminal paper. Mundell won the Nobel Prize. So if you're not going to close the capital account and you're not going to raise interest rates, you must devalue the currency. There's no other way out. Now, you can be in denial about that and try to pretend it's not happening, but your capital account's going to go to 0 if you give it enough time. China is obviously not going to allow their capital account to go to 0, so they have to devalue. So they figured this out last August. They do this shock devaluation. What happens? U.S. markets melt down. August 31st, U.S. investors were staring into the abyss. Our markets look like they were down about 10%, which is in a couple weeks. That's a huge shock in a couple of weeks. Looked like there was no bottom, and then finally Janet Yellen decided not to raise interest rates in September. The market got a relief rally, et cetera, but we're still in that mode. So on the one hand, China needs to devalue. On the other hand, they can't devalue without shocking the markets, without taking Western markets down. So how do you devalue without devaluing? You get the other guys to make their currency go up. In other words, instead of the Chinese saying, we're taking our currency down, you get the Japanese and the Europeans to say, we're taking our currency up. And that's exactly what happened. So what did Draghi do on March 10th? He said, well, he did the minimum, right? 10 and 10, 10 billion more QE, 10 basis points in negative interest rates. That was the minimum. A lot of people were saying maybe he'll do 20 and 20, 30 and 30. He did 10 and 10, and then he shocked the markets by saying, by the way, we're done. That's all I want to do. So when the market expects more and you don't do it, that's tightening. He didn't raise rates, but he did, in effect, raise rates or tighten relative to expectations. The euro rallies on that. So what does Kuroda do? Everyone expects some easing, Japanese bazooka, more QQE. Now we're going to buy, flower arrangements, whatever. No, he says he does nothing. So again, relative to expectations, that's a tightening. So now the euro is screaming, the yen's screaming. What's happening to the Chinese yuan cross rate to euro and yen? It's going down. So China's getting the devaluation not by their action, but by the action of the other central banks. And finally, what's the tell, right? You know, the tell, the giveaway in a poker game, what's the tell? The tell is if the yuan goes down against the dollar, because like, oh, no, you Chinese, now you're devaluing, because the Americans are obsessed with everything dollar. They don't even look around the rest of the world, right? So the Fed eases. So Europe and Japan tighten. The Fed eases. So if if China's getting the benefit of ease and the Fed's actually easing, what happens to the yuan dollar cross rate? It's unchanged. Nothing happens. So everyone's like, the Chinese didn't devalue. Look at the cross rate. But meanwhile, versus the euro and the yen, and this is the continuation of the currency wars. And how have the currency wars gone? 2009, cheap yuan. 2011, cheap dollar. 2013, cheap yen. Abenomics, right? One of the three arrows. 2014, cheap euro. How did they do that? Euro QE in January 2015, negative interest rates in June 2014. So now it's time for the U.S. and China to devalue, and Europe and Japan are going to they have to suck it up. Now because everybody would like to devalue their currencies at once. I mean, we'd like that, but it's a mathematical impossibility. So the next big benchmark is April 13th, IMF, spring meeting, Washington, D.C. As we know, the G20 meet on the sidelines of the IMF. The IMF is kind of like a front for a mob that's meeting in the back room. The mob is the G20 and the G4 in particular. The IMF has got this nice facade. So they'll have the usual public agenda and public press conferences and all that, the IMF spring meeting in Washington on April 13th. But behind the scenes, I think the big four, Japan, China, US, and Europe, they're going to sit down and evaluate their handiwork and decide where to go from there. My estimate is they'll do more of the same. That China needs a break. China can't do it unilaterally. The other countries are willing to help.